So the reason why oil prices or gas prices are higher on the West Coast than it is on the East Coast, there's a couple of different reasons, but one is pipeline activity, right? When most of the when most gasoline is being produced, and I'm calling it the East Coast, but it's really between Oklahoma and Texas, right? The cost to pipe the cost to send it to the West Coast because of the Continental Divide is much higher. So a lot of the gasoline that is being refined and distributed on the West Coast happens on the West Coast, right? Plus there's also extra taxes that California and a few other states put on it. So you're always going to have higher prices there. And I agree with you. You are going to see $10 gas in California. Mark my words. You're going to see it soon.
Yeah.
Because this hasn't ended. But the other important thing is we put all these sanctions on Russia weeks ago. And it really it was really this week that there's like, oh, by the way, we put all these economic sanctions on Russia, but now we're also not going to take their oil and gas. Well, wait a minute. Like, I thought you already put sanctions on Russia. But now you're deciding that you're not going to buy their oil and gas. And by the way, in Western Europe, they're still purchasing Russian oil and gas, right? But all that being said, as far as oil coming to the United States, Russia accounts for much less than 3% of all U.S. oil. Most of it's produced here, first of all. And then the rest of it is imported, from the Middle East. So Russian oil shouldn't have that much of effect,
right, on price. Yeah, on the price, it should have nowhere near a 40 to 50% effect like we've seen in the last 12 months, right? I mean, that's totally bonkers to assume that.
Yeah.
I think. Yeah, go ahead.
And you were talking about, different laws of economics. If you remember from, college days, Adam Smith's 3 laws of economics, right? The law of supply and demand, the law of self-interest, and the law of competition. Okay.
Yep.
So the law of supply and demand isn't really at play here because there's not that much less supply cutting off Russia. The supply is the same.
Yep.
The demand side's the same. It really has to do with inflation, right? But the reason why prices are shooting up higher than they should have on a reactionary note is really the law of self-interest.
Yep.
There's an opportunity to charge more, therefore they will.
Yeah.
Right. And law of competition. There's not much outside competition here. So anyway, all that being said, the price of oil that we're seeing today was a reactionary effect to the Ukraine-Russian conflict, but it was where the price of oil was already headed due to inflation.
Yeah.
So I estimate the fair value of oil at somewhere between, let's just say somewhere between $130 and $150 a barrel. And we're about we're at the low range of that. But as always, when there's high inflation, when there's supply chain issues, when there's events like the war, you'll always have a swing to the other side. So it's possible that we're going to see oil prices between 150 and 180 a barrel. Now, what does that do to the price of gasoline? Well, it drives up gasoline to $10 a barrel. I mean, sorry, $10 a gallon in California.
Yeah.
And probably, places like the South, which the South is usually cheaper because it's closer to the source, right? It's closer to Houston, it's closer to Cushing, closer to the refineries. And so we'll probably see, if we're seeing $4 now, we'll probably see something like $6 in the near term.
Yeah, I think with the knock-on effect of gas and oil prices, as you have to transport everything, because we haven't figured out 3D printing food yet, and we haven't figured out teleportation, right? So we still need to move things around. And unless we're suddenly going to start going heavily on trains and then using all this coal to move trains around, they're still going to continue to use big rigs for the majority of the intercontinental transport. And I think, like you said, back to the Adam Smith's laws, if you sort of have like a triangle, right? And if one of those legs goes down, then the other one goes up. It's just like, because there's always this balance. So as it tips around, if you eliminate competition, then self-interest goes to the moon, and if you eliminate supply, then demand goes up, almost as like a psychological reaction, because self-interest is tied with demand, right? So for the good itself, and then that creates competition between the consumers, not necessarily competition between the sellers. And that's really where it gets kind of wonky.